Let's talk about the Indian markets today. If you've been keeping an eye on the charts lately, you've probably noticed a dip in both the Nifty 50 and Sensex. They've both dropped by about 3% just in the last 5 days. So what's really going on behind the scenes? Well, there's a lot happening and it's just not one thing. A big part of it is foreign investors pulling out crores from the Indian market. In fact, so far in 2025, these investors have pulled out more than 88,000 crore rupees from the markets. Now, there's a huge amount of money leaving and it's definitely having an impact. But here's the thing, this selling spree is continuing despite the government's recent budget announcements which were expected to boost personal consumption. On top of that, the Reserve Bank of India even cut the repo rate by 25 basis points to try and stimulate the economy. So with all of these positive moves, why are we still seeing such aggressive selling? Well, it comes down to a few key factors. First, let's talk about the US Federal Reserve because right now, that's really at the heart of what's driving investor sentiment globally. Now, the US Fed chair recently made some hawkish comments that have spooked the markets. Now, if the US Fed signals the interest rates will stay higher for longer, it makes places like India look riskier compared to safer US bonds, which offer better returns with less risk. Now, just to put this in perspective, the yield on the 10-year US Treasury notes has risen for 5 straight days, surpassing 4.5%. Now, the US Fed has already cut rates 3 times this year, but investors are still uncertain about what comes next. In fact, hopes for more rate cuts this year were dashed when the Fed chair reaffirmed the Fed's cautious stance, saying they're not under pressure to cut rates anytime soon, especially with inflation still high, which inched up to 2.9% in December. Now, add to this fact that there's a new US president in office. Donald Trump's policies are starting to create additional uncertainty. Higher tariffs, tougher migration rules, and changes to fiscal policies could push inflation in the US up in the short term. And this is already affecting how investors are making decisions. They're becoming more cautious. In fact, on Feb 1st, Trump announced new 25% tariffs on imports from Canada and Mexico, and China will also face a new 10% tariff. Now, that's adding to the global tension and market anxiety. Now, to make matters more complicated, Trump's move to expand tariffs on steel and aluminum imports has reignited fears of a broader trade war. On Feb 10th, he signed an executive order increasing aluminum tariffs from 10% to 25% and reimposed a 25% tariffs on steel imports that previously entered the US duty-free. Now, you might be wondering how this affects India. The good news is that India isn't on the initial tariff list, but there are still 2 key ways this will impact us. First, the uncertainty created by these tariffs can disrupt global supply chains. Now, since India still depends heavily on imports for many components, this can create inflation pressures in the Indian economy. But perhaps the bigger concern is that local businesses already feeling cautious may delay their investment decisions. Now, this would slow down economic growth, which is already being weighed down by slow capital expenditure growth. Now, when private investments doesn't pick up or gets delayed, it can be a real drag on the economy. Now, there is also another factor, which is the strengthening of the US dollar and the falling rupee. Now, the tariffs imposed by the US have been creating ripples in the global currency markets, causing the dollar to steadily rise. Now, since the market started to absorb the impact of Trump's policy stance back in September, the dollar index has jumped from 100 to 108. On the back of this, the rupee has significantly weakened, falling to around 87. And this depreciation of our currency is notable. Now, a weaker rupee means that the cost of imports for India increases, which naturally leads to inflation pressures. On the other hand, a cheaper rupee can make Indian exports more competitive in the global markets. But the real question is how the balance between imports and exports plays out. Now, moving on to something that's on everyone's mind, the Q3 corporate earnings. As we know, it's earnings season with companies reporting their Q3 results for fiscal year 25. This is a crucial time for the markets because earnings season tend to provide insights into the financial health of companies and how they're performing in the current environment. But it is important to keep in mind that the stock market is a forward-looking indicator. It's just not reflecting what's happening right now. It's thinking ahead and is often supported by strong earnings growth. When companies report strong earnings, it usually gives the market a boost and signals confidence for the future. However, the earnings picture this time around isn't entirely rosy. Now, the EPS or the earnings per share cuts for Nifty 50 companies, which began in the second quarter of this fiscal year, have continued into the December quarter. Now, according to JM Financial, the number of EPS cuts has far outpaced the upgrades. To give you a sense of this, about 36 or roughly 72% of Nifty 50 companies have had their earnings forecast downgraded. Now, what we're seeing are moderate earning results that haven't quite hit expectations. This has caused analysts to revise their earnings projections downwards to account for weaker than expected revenue growth, margin pressures, and a more cautious management outlook for the coming quarters. So the corporate earnings is another big factor impacting the markets. So here's the thing. Even though there are risks out there like global trade tensions and unpredictable economic growth, the current market correction actually presents a chance to invest in solid companies that might be undervalued right now due to these short-term ups and downs. Now, if you're thinking long-term, this could be a great opportunity to build a portfolio of strong businesses. And if you're doing a systematic investment plan or the SIPs, don't stop just because of a market downturn. I know it might feel tempting to pause, but that's actually a mistake. If you stop, you'll miss out on the benefits of rupee cost averaging and buying stocks at low prices. So our advice is to stay cautious but don't panic. Stick to your plan, keep investing, and remember these corrections can actually work in your favor if you're in it for the long run. Having said that, this is me, Merlin Stana, signing off. Take care and stay invested.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.